Paying down a fixed and low interest rate mortgage in today's environment is one of the worst financial mistakes one can make. In this video, I will share with you my thoughts on this through a detailed example to show you why I'm saying this. Hey friends, welcome back to the channel. My name is Alex. I am a lawyer based in Romania, and on this channel we explore the tools and strategies that help us become financially independent and wealthy. Look, if your goal is like mine, to become wealthy and financially independent, to never have to worry about money ever again, then I hope that this video will be eye-opening. I totally agree that paying down a mortgage faster has its emotional benefits, but in today's environment, it does not make financial sense to do it when the difference can mean, in certain situations, like millions of dollars. To drive my point, let's make this fun, go through a real-life example, and see why you should not focus on paying down the mortgage over investing, and then shortly talk about the mechanics behind this. Mr. Federico decides to buy a house for around $500,000. He sends his documents and he qualifies for a 30-year fixed-rate mortgage at 3.2%. He decides to go ahead, make the purchase, and move in so he can spend the Christmas with Mrs. Federico in the new house. At the end of the month, after paying down all the expenses, Mr. Federico has $1,500 left in savings, which he decides what to do with, like pay down the mortgage faster or invest in the Vanguard Total Stock Market Index or another total stock market index, because it does not really matter. As chair of the Federal Reserve, he decides to do some 11th grade math, so he pulls up his online calculator and starts running through the scenarios. In addition, Mr. Federico printed a ton of money over the past 24 months, so he knows that for the next couple of years, inflation is probably going to run about 3 to 5% every single year. Good, that means that he basically borrowed money for almost nothing. Mr. Federico thinks a bit and he realizes that if he pays down the mortgage sooner, basically what he's going to make is around 3% excluding inflation. If he takes into consideration the inflation, what he's making is basically nothing, or he loses around 2% due to inflation, because inflation is eating on that interest rate that the bank is making. So basically the bank is holding the risk of inflation on a fixed rate mortgage. So if he pays down the mortgage in 15 years instead of in 30 years, the most he's making in dollar terms is around $132,000, which he saves on interest. In real terms, he's basically making nothing because inflation would have negated that anyway. Now, he does the math for the total stock market index alternative. He knows that over the long term, the returns are around 8% adjusted for inflation. So he does his 11th grade math on $1,500 invested every single month for 15 years. And he sees that his investment return is going to be $524,000. Wow, money printer go brr! That's a difference, boy. A positive difference of almost $400,000. Now he runs the math for 30 years, for the entire duration of the loan. If he does not pay the mortgage early and just makes the regular payment and invests the difference into the Vanguard Total Stock Market Index, he's going to end up with $2.25 million while paying $278,000 in interest. That's peanuts. It's a positive difference of around $2 million. Now, Mr. Federico, to be fair, compares this with the scenario where he would invest after year 15 the monthly payment that he used to make for the mortgage plus the $1,500 that he's saving if he decides to not finance a boat, because he has something with boats. So to be fair, he tells himself that he's going to restrain himself and then invest everything in the total stock market index to see what the returns would be if he would redirect after year 15 everything else into the total stock market index. Well, he sees that the result is going to be $1.27 million while saving $132,000 in interest. In total, that's around $1.4 million. But still, it's $600,000 shy of $2 million that he would have as wealth if he would just dollar cost average in the total stock market index and make the regular payment for the 30 years. Now, Mr. Federico lights up his cigar with the freshly printed $100 bill, relaxing in his chair, knowing that in 30 years he would have a net worth of an additional $2 million, a fully paid home if he just dollar cost averages in the Vanguard total stock market index and makes his regular mortgage payment every single month. You might be asking, why is this happening? Well, that's because the interest rates are at an all-time low, in most cases below the rate of inflation, which is unheard of. Because interest rates are so low and inflation is typically in today's environment running above the rate that the bank is charging as interest for the fixed rate mortgages, you can take advantage of this inefficiency in the market, borrow cheap money, buy assets that are going to go up in value, at least with the rate of inflation, because, well, Mr. Federico's house will probably go up in value, at least with the rate of inflation too, and invest all the free cash flow or the savings that you have in an alternative that is going to earn a lot more than the interest rate that you are paying to the bank. When you are borrowing money on a fixed rate long-term mortgage, like a 15-year mortgage or a 30-year mortgage, the bank holds the risk of inflation on the money it lends. The higher the inflation rate, the easier it's going to be to pay down the mortgage in the future, because you will pay it with cheaper money, because the purchasing power of the monthly payment is going to be lower and lower and lower as we go ahead in the future and as inflation eats that purchasing power. Like today, for example, in the United States, a 30-year fixed rate mortgage is around 3.2%, while the inflation is around 6.9%. That means that you can basically borrow money at 3.2% while inflation is going to be 6.8%. So you are basically pocketing the 3.7% difference by just borrowing the money and buying an asset. Even if the inflation would be lower than this, like 1% or 2%, it makes a lot more sense to borrow money, buy an asset that is likely going to go up in value by at least the rate of inflation plus a premium, which is mostly the case with houses, and then invest everything that you have in addition to the monthly payment that you're going to make on that borrowed money in other assets that are going to go up in value by at least the rate of inflation. Like, for example, in case of hyperinflation, that debt, the fixed rate debt, is going to be devalued so much that it's going to be so easy to be paid in the future that you might have to sell only one asset to pay down 10 assets. So in effect, by borrowing money and then just making the minimum payment, you are pocketing the difference, because you can make a lot more money on your savings in other investments like the total stock market index or the S&P 500, and not paying down the mortgage, which guarantees only a 3.2% return. Yeah, it might give you an emotional benefit by paying it early, knowing that you have no debt, but you're leaving money on the table, and in most cases going to be at least $500,000 to $1 million on just the amounts that we talked about, like on $500,000 invested and just redirecting $1,500 every single month. So if your goal is to become wealthy and financially independent, borrow cheap money and buy yourself a house, and then make the payment, the monthly payment, and do not focus on paying down the mortgage early. Redirect all your savings to other investments, and you will be better off and wealthier in the future. I mean, by the time this video goes out, it might not be holidays, but in any case, happy holidays everyone. And if you enjoyed this video, you might like this other video that I made about financial independence. Take care and have a wonderful day. Peace.